Hello friends, welcome to my YouTube channel Tech with Imran 013. I hope you all are fine. The topic of this video is commercial mortgages. Some key characteristics include: the borrower is generally a company, such as a corporation or a partnership, although individuals can still own commercial properties. The borrower is not servicing the mortgage with personal earnings, cash to receive. The mortgage obligation comes from either business operations if they run a company on site, or rental income if it's an investment property. Understanding the cash flows for a business operation requires a much more extensive analysis of the underlying business, including its financial health, management capabilities, and competitive advantages. Understanding default risk for a rental property is even more difficult, as the lender will not have access to the tenant's financial information. Commercial mortgages deals for investment properties are analyzed based on the geographic location, the quality of the property, and the strength of the lease agreement. Commercial properties tend to have many restrictions on uses and therefore fewer prospective occupants. This generally means much lower LTVs, loan to values, more like 50% to 70%. Mortgage payments. A mortgage payment is made up of two components: interest and principal. Interest rates vary by jurisdiction and other market conditions. The risk of the borrower and the borrowing request also influence interest rates. Interest rates are generally either fixed or variable, often called floating. The principal portion of the payment amount goes toward paying down the original mortgage's amount understanding. The original amount outstanding is usually scheduled to be repaid to zero on the last payment of the amortization period, which may be 25 to 30 years. Because the amortization periods of mortgage loans are so long, it tends to be that a high proportion of the payment amount early in the amortization period in interest, with the inverse being true as time progresses. The below chart illustrates this using as $10 lakh loan on a 300-month amortization with a 5% interest rate. Who provides mortgage loans? Mortgage loans are often made by banks and other traditional financial institutions like credit unions, but not always. Life insurance companies, pension funds, and other large asset management firms also have mortgage lending arms. In fact, mortgage loans from the lender's perspective tend to represent very stable and consistent sources of future cash flows by way of the borrower's monthly payments. Mortgages are also issued by other private investors, both individual and institutional. These parties pool funds into various forms of mortgage trust to create private lending entities. These funds are often deployed to home buyers and real estate investors by way of mortgage brokerage companies. A mortgage broker is not themselves a direct lender. A borrower will generally enlist the services of a mortgage broker to help them shop around to all the previously noted mortgage lenders in order to secure the best rate and terms for their borrower. The broker is typically paid by the lender that closes the deal. I hope you all like this video. For more informative video, please like, share and subscribe to my YouTube channel.